Welcome back to the LeverUp AMA series. I'm Marcus, and today we're talking about a specific protocol update that caught a lot of attention in the community this week. LeverUp has raised leverage on all listed stock perps to 100x. Same ceiling, every name. Tesla, Nvidia, MSTR, all of it. My guest is James from the LeverUp team. James, thanks for being here.
Good to be here, Marcus.
Let's get straight into it. 100x leverage on stock perps. That's a big number. Before we talk about what LeverUp did, give me the background. Why is stock leverage usually not uniform across platforms? What's the typical setup?
So on most perpetual futures platforms, leverage limits are tiered by asset. You'll see something like large-cap high-volume names get a higher ceiling, maybe 25x or 50x. Less followed names, maybe 5x or 10x. And that tiering isn't arbitrary. It's directly tied to how those platforms source liquidity.
Meaning the LP pool depth.
Exactly. In a liquidity pool-based system, the depth of the pool sets the practical leverage limit on each market. Thinner markets where the pool has less capital allocated, force lower caps. The logic is that the pool needs to protect itself from adverse selection. If a name has thin liquidity and you let traders lever up heavily on it, the pool takes on more risk than it can absorb. So the parameters get tightened.
Which means traders on less followed names are penalized. Lower leverage, worse access. Not because the asset is inherently untradeable at higher leverage, but because the liquidity architecture can't support it.
That's the right framing. The ceiling is a function of pool capitalization per market, not purely a function of the asset's characteristics.
Okay, so that's the typical setup. Now walk me through why LeverUp can do something different. What's the architecture that makes a uniform 100x ceiling across all names possible?
LeverUp runs on what we call a protocol-managed virtual liquidity architecture. We don't source liquidity from an external LP pool. There's no pool that gets deeper or shallower depending on how much capital LPs choose to deposit into a specific market.
So where does the liquidity actually come from?
Open interest scales with protocol risk parameters rather than with the size of an externally supplied LP pool. The protocol manages risk at the system level through its own parameters, funding rate dynamics, margin requirements, rather than delegating that responsibility to external liquidity providers who are making per-market capital allocation decisions.
Break that down for me. What does protocol risk parameters actually mean in practice?
It means the protocol has internal controls, things like position size limits, margin requirements, funding rate mechanisms that govern how much aggregate open interest can build up on any given market, and at what cost to the trader holding that position. Those controls are set at the protocol layer, not determined by how much an LP deposited into a specific pool this week.
So the leverage ceiling on Tesla stock perps isn't constrained by how much liquidity is sitting in a Tesla-specific pool.
Correct, that dependency doesn't exist in this architecture, which is why the upgrade to a uniform 100x ceiling across all currently listed stock perps was possible to implement consistently. It's not blocked by individual market liquidity depth.
Let me push on something here. Traders hearing 100x on every stock might assume that means uniform risk too, that Nvidia at 100x is the same risk profile as some smaller cap name at 100x. Is that accurate?
No, and that's worth being precise about. The leverage ceiling being uniform doesn't mean every underlying asset behaves the same way at high leverage. Different stocks have different volatility profiles. A name that moves 3% intraday carries very different liquidation risk at 100x than a name that moves 0.5% intraday.
So the ceiling being equal doesn't mean the risk is equal.
That's exactly right. At 100x, a 1% adverse move against a position equals the full initial margin. That's the math. It's constant regardless of which stock you're trading. But how often a given asset moves 1% against you in a short window is absolutely a function of the individual asset. Traders need to account for that.
That's a real distinction. The platform lifted the ceiling uniformly, but whether it makes sense for a trader to use that ceiling on a given name is still a per-asset judgment call.
Right, and position size, not max leverage, is really the primary risk control here. You can access 100x across all names, but using that ceiling on a volatile name with a large position is a different risk proposition than using it on a lower volatility name with a smaller position.
Let's talk about what actually changed operationally for traders. Someone who's been trading stock perps on LeverUp. What's different today versus before this upgrade?
The most direct change is that access is now uniform. Before this upgrade, some names had lower leverage caps than others. That tiering is gone. Every currently listed stock perp now carries the same 100x ceiling.
And this isn't a promotional thing. It's not 100x for a limited time on featured names.
Correct, this is not a time-limited promotion. The upgrade is live and applies uniformly to all currently listed stock perps under current protocol parameters.
Good to clarify. I've seen that pattern elsewhere. Platforms run a temporary leverage promotion to generate volume and then quietly walk it back.
That's not what this is. The ceiling is set at the protocol level, not as a marketing feature.
You mentioned funding rate dynamics a moment ago. How does this upgrade interact with funding rates? If traders start piling into heavily leveraged stock positions, does that affect the funding rate environment?
Yes, and this is important. Higher open interest on a given market does affect funding rates. That's by design. Funding rates are one of the mechanisms the protocol uses to manage aggregate risk exposure. If one side of a market becomes heavily skewed, a lot of open long interest building up. For example, the funding rate will reflect that imbalance.
So traders using high leverage need to factor in funding rate costs as part of their position economics.
Absolutely, the leverage ceiling being 100x doesn't mean funding is free. If you're holding a large, heavily leveraged long position in a skewed market, funding costs compound. That's a real P&L factor over time.
This is the kind of thing that can eat a position alive if traders don't model it properly.
Correct, especially at high leverage, where the margin buffer is thin. A position that's technically open, not liquidated, can still get ground down by funding if the market stays skewed against you for an extended period.
Let's talk about AnyCollateral, because LeverUp supports non-stable coin collateral. How does this upgrade interact with AnyCollateral positions?
AnyCollateral positions carry two independent risk vectors. Both the trade and the collateral token price can trigger liquidation. That's always been true for AnyCollateral, and it's worth highlighting in the context of high leverage positions specifically.
So if I'm running a 100x stock perp position collateralized by, say, an altcoin, I'm exposed to the stock moving against me and my collateral depreciating at the same time.
That's the scenario. Both vectors can move simultaneously and in adverse directions. At 100x, that combination can compress margin very quickly.
So for traders using AnyCollateral at high leverage, they're not just managing one risk, they're managing two.
Two independent liquidation triggers. Traders should model both when sizing their positions.
All right, let me ask the direct question. Why should traders care about this update? The headline is 100x on all stock perps, but what's the actual use case? Who is this for?
There are a few distinct use cases. First, traders who want to take a directional view on equities with defined margin risk. High leverage means you can express a view with a small position while keeping the rest of your capital deployed elsewhere. Second, traders who are hedging equity exposure and need precise sizing flexibility. Third, traders who previously avoided certain stock names because the leverage ceiling was too low for their strategy to be viable. That constraint is now removed across all listed names.
What about traders who were specifically going after the less followed names that had lower caps before?
That's exactly who benefits most directly. If a name had a 10x or 25x ceiling before and you had a strategy that required more leverage, you were either forced to use a different asset, a different platform, or abandon the strategy. Now the ceiling is consistent. Whether any individual trader should actually use 100x on a given name is still a separate judgment, but the structural barrier is gone.
That's a fair answer. You're not telling people they should be trading 100x. You're saying the option is now uniformly available.
That's the right characterization. Access is uniform. The decision about whether and how to use that access is still the trader's.
Last question. Any other protocol parameter changes tied to this upgrade, margin requirements, position size limits, anything else that shifted alongside the leverage ceiling?
The upgrade is specifically to the leverage ceiling across currently listed stock perps. There's no separate liquidation penalty fee under current protocol parameters that hasn't changed. The core risk mechanics are the same. What changed is the ceiling. Traders should review the current protocol parameters directly if they want the full picture before sizing into positions.
Solid, James. Appreciate you walking through this.
Thanks for having me.
That's the AMA for this week. 100x on all listed stock perps, uniform ceiling, live now. Read the full article for the written breakdown, links in the description. We'll see you next time.